Good morning, it's Peter Stimson here from Empowered Mortgages. It's Thursday the 12th of June and we thought we'd do a quick market update. We haven't done one of these for a little while, and the reason we haven't done one is because the market's been incredibly benign. Swaps haven't moved for approximately sort of a month or so. They are moving now and they're moving downwards, which is potentially good news if you're a mortgage holder. And they're moving down for a couple of reasons. First off, we had payroll data out on the 10th, which showed that number of people employed in the UK dropped by 109,000. That number needs to be taken with a little bit of a pinch of salt because that data number tends to get revised upwards, often quite significantly. But the general trend is continually down. So we've had now 10 months of continual sort of falling UK payroll numbers. So, that's, generally indicating that the UK economy is not in so robust health. And this morning we've had UK GDP numbers again, which is a negative number, and more than expected. We're expecting a sort of like a minus 0.1. We've got minus 0.3. There is quite a bit of seasonality on UK GDP, particularly at the moment, and a lot of the UK manufacturing was brought forward into Q1 given the tariff numbers. So again, a little bit of a pinch of salt on some of the GDP numbers. But both of those numbers were more negative than expected, and that's pushing across into the swap numbers, as you can see from the graph that's going up at the moment. What does that mean in terms of impact on rates? Well, we can probably, we're still expecting a base rate cut, maybe brought forward perhaps now to August, maybe September. So probably not expecting the sort of general change in the general sort of direction of things. The biggest impact's probably going to be on Rachel Reeves and her budget. Obviously, we had the announcements around spending, obviously more spending on defence, health, that kind of thing. Very small fiscal headroom for Rachel. Probably going to run out very quickly at the moment, which means she's either going to have to raise taxes or raise borrowing. Borrowing is going to be a big problem. If she raises borrowing, obviously that's going to push across into government gilts and obviously going to push pressure onto swaps. If pressure goes onto swaps, that's obviously going to raise borrowing costs for borrowers. So we think that's obviously going to be very challenging at the moment. So a lot of volatility still potentially to come into the UK swap market from that side of things. In terms of what does that mean for borrowers and what does that mean for the markets going forward? We still think we're kind of bouncing around near where the bottom of the swap market's probably going to be, particularly if we talk to some traders and stuff like that. One trend we're seeing, which we're finding probably a little bit not concerning but a little bit strange, is we've had a look at the amount of ESIS being done on sort of 2, 3 and 5 year, and we're still not really seeing any pickup in the number of 5-year mortgages being sold, which maybe is a bit strange, particularly as we're thinking we're probably at or near the bottom of the rate curve. So that's probably something we'll touch on in later videos on that side of things. If you're getting a sort of a 5-year fix at or near 4%, that's probably a pretty good deal, particularly given the uncertainty that's out there. There's no, like I say, guarantee that rates continue to trend downwards. We're getting, obviously in the last month or so, we got rates going up, rates are going down. It's kind of bouncing along really at the bottom at the moment. So, we'll see where things go. That's it from me. If anything changes, we'll let you know. Have a good week.